Craig here from Advice and Financial Management, talking to you from the CME trading floor about the week ahead and other stuff. And so today we had the PCE out, which came bang in line and has basically a big impact on what Jerome Powell will do with rates going forward. So also just going through what's happening today for Friday. The stocks market is not doing too great at the moment, showing down, S&P's down 50. So only that's less than 1% though, but still trending lower at the moment. The SOFR yield curve showing slightly lower in rates, with an ever so slightly increase in the chance of the first cut coming at the September meeting. We did have where are we? One of the Fed governors talking this morning, stating about how they do believe that we should have a rate cut at the next meeting. And so nothing too much other than that going on today. What do we have for next week? Well, first of all, there is a holiday in the US on Monday, following the UK's one this week. So don't expect anything to happen on Monday. So for those guys of you listening out of Europe, yeah, it's going to be dead. But the main focus is, as far as US goes, is going to be the jobs numbers that are coming out on Friday. We'll touch on that in a second. And with Fed Governor Waller that was talking about the possibility regarding the usual rate cuts. That will probably hinge on the jobs number that comes out next week. So with that, what actually are we looking at? The projected gain is 78,000 jobs for next week. And probably, and then on the back of that, obviously, if it comes in very weak, I think you're almost certainly going to see a cut in September, where we're pricing at the moment over 80% chance anyway. But a strong number will possibly see a resistance to that, as we are still trying to figure out exactly how the tariffs are going to affect the economy going forward. We will touch on that in a bit. But anyway, yes, so there is an expectation that the weak numbers will reinforce that chance of that 25 basis point cut, and maybe more than that going forward. Then looking ahead at the earnings we have out next week. Just going here. So we have the ones that obviously got nothing out on Monday. The two that I would say that could be interesting: Salesforce, that is on Wednesday. Also American Eagle. We'll find out if boobs do sell jeans, and whether or not there was any effect from that. I'm now going to go, before I talk about anything to do with tariffs, I want to go to have a quick look at NVIDIA. We talked about NVIDIA numbers and what you could do as far as option plays go at the beginning of last week. We had two trays. We can have a look at those and how they're doing at the moment, if there's anything that is worth doing going forward. Now, the NVIDIA, although it came out with some decent numbers, there were part of it that some people didn't like. I think it was the income from the data centers. But either way, it's still a very strong sector. and we see that but looking at the chart, if you have hang on, let me just try and get one up here for you. There's a good chance of a potential further pullback. Only more corrective than anything else. I wouldn't necessarily say it's a complete trend change, but we've marked down from 181 prior to the numbers down around 175 where we're trading at the moment. And if I was to look at a scenario, we ran a scenario of looking at a downside target around the 140 area. It's still, our system still likes the 1x2 put spreads, but I don't like those for beginners. There's downside risk by net selling options. So if we look at premium only trades, it still likes the one that we looked at, which is the 120, 135, 150 put flat. I like that trade. It's cheap at 90 cents. That's where you get in and out around $8.70, something like that. It works really nicely on the downside. I would, let's just go to the detailed report here, and you can see that. As you can see here, it just covers that area on the downside really nicely with a fairly minimal risk. So if you're targeting that area, it's just a good spot to have with a fairly minimal outlay. So there you can see here, covering that whole area. It's going to monetize better the closer you get to expiration, but even if it happens relatively soon, you're still going to make a decent return. You're talking about 4 times your money if you get that right. Going back though, on the bullish scenario, still looking more like call spreads. If you like the upside from where we are now, target that 210, 230 call spread. That's the one that is going to give you the best return, and that one comes in at around 60 cents to buy. And if we get anywhere near there, then that's going to be a very healthy return on that one. And so just remember, when we talk about these trades, we are looking more long term than probably that you're used to. A lot of you guys are trending or basically doing trades for a quick return, focusing on like 1 to 2 days. We don't do that. We're looking at capturing trends and making money, which is why we're looking at an October expiration when we look at these trades. There's more chance of you making money and less chance of you losing, which to me is what it's about. And so anyway, so those are the trades we like there. We will do something on Salesforce next week. So if any of you have any views on Salesforce, please DM me or message us through our various platforms, either Reddit or LinkedIn or directly from our website, leviathanfm.com, and we can run some scenarios for you and have those in your inbox. And so now moving on to one of the things I wanted to talk about was tariffs. Tariffs are a tax. They're a tax on US companies. It's not a tax on foreign entities. Now, how is that going to affect us going forward? Because basically that was one of the things that Powell was mentioning in his speech this week, was that although the economy is looking pretty resilient, the effects of tariffs on inflation is still unknown. I came across this chart this week. I quite liked it. It's probably one of the better ones that visualize what and how it will work over time. And basically, you can see here how, at the moment, I think that we're in a situation where a lot of companies are assessing what, number one, how much it's going to be, how much is it going to cost. That's what you do. It's been very uncertain up until now, but we seem to be settling down to a point where you can actually go, okay, this is what I'm paying here. And then the next thing companies do is looking for ways to get out of it. You know, are there loopholes that can exempt you from having to pay these tariffs when you come in? You know, or what percentage of my thing that I'm building that is made up of parts from other countries, am I going to have to pay tax on, you know, if I've already got the assembled part? And yeah, once they figure this out and they know what the charge will be, that will more than likely get fed through to the consumer, because, you know, up until now they've been sucking it up, but at some point that will feed through. And you can see here things like metals, clothing, crops, equipment, and will eventually get fed through. You'll probably see a spike in inflation in your prices, and then it will taper off on the long run to protect companies and their earnings. But we are going to be the ones paying it. Now, how will that affect the market? The Fed's mandate is to keep control of inflation. That is what they really want to do, and so they're stuck in a position where, okay, you almost guaranteed to see a spike in prices. Will it be transitory? Will it just be like a one-off, or will it go more like this particular chart and spike but still have increases going forward as companies try to protect themselves from ongoing changes in that policy? So that's the big question, and at the end of the day there is no clear answer on that, which is why we haven't had the rates cut yet. So we'll see. You know, it's I think that that's why the focus by Powell will be on the economic numbers, seeing how it filters through into the various inflation gauges and how that will affect people's spending patterns going forward. You know, are people going to be afraid that it stops spending and this can spiral and hurt the economy, or will it just remain resilient and we just suck it up and take in there 10-15% increase in prices ourselves without batting an eyelid? Hard to say, because up to now the economy's been pretty damn strong. Hasn't really had anything that has been over the top of it, but we shall see. Wasn't a fan of the ending of the de minimis tariff exemption, which has meant now a bunch of countries are no longer sending us even mail, and a lot of smaller items that we take for granted seem to not be applying. Again, we're just going to accept that, just move on, or buy American products instead. I don't know, that remains to be seen. So let's have a look at what else is going on here. The other things to keep an eye on, although I believe is going to be the French bonds. I mentioned it earlier this week in the morning meeting, is that there's obviously a lot of political shenanigans going on in France, and we'll have a vote on, I think it's September the 8th, as to whether or not there will be a vote of no confidence in the Prime Minister there, and how that will affect the French markets going forward. It is going to be a potential big deal if you have a bond market rout, and if that happens, as to whether or not that is going to be contagious. We certainly don't want that coming over here. We want stability in our bonds, because obviously the more we spend on interest payments, the less money we have to spend on anything else. So keep an eye on France and the jib political flashpoints coming out of there. See, so we've got the labour market we talked about. We have various consumer sentiment numbers coming out as well, but I think the focus is definitely going to be more the jobs data. So for those of you trading equities, keep an eye on jobs data and keep an eye on any interest rate curve. That is going to have a knock-on effect to your equity markets. And I believe in this case it's not, the dog is going to be the interest rates and the equity market the tail. So just keep an eye on the rate markets there. That will be the one that will guide us going forward. So in our shortened week next week, I think that's pretty much it to keep an eye on. Again, please visit our website www.leviathanfm.com. And at the moment we are running just a buck membership, which will give you basically institutional grade option analysis via our AI platform. I can explain about that if anyone wants to. Again, please DM me on that one. But yeah, the only reason we're charging $1 is so we don't get we have legit people that are interested in joining up and having some fun with us in the world of options. And that will be www.leviathanfm.com. And that is going to be it for me for now. For all of you, as I always say, it's always better to be lucky than good. So, yeah, hang on. And so, everyone, best of luck. And I have to go off and do a trade. So, best of luck, good luck trading, and have a great weekend, everyone. Yeah. Can I get that, Jan? O plus 1 plus